everybody talks about Warren Buffett as, the world's greatest investor. And if you read about Warren Buffett, you'll come to understand that whilst he's perceived as the world's greatest investor, he's also made a lot of mistakes along the way, and he openly admits that. How do you see Warren Buffett as an investor, and as, perhaps somebody might think about emulating, and the difference between what Warren suggests to people who want to follow him compared to the way that you would view investing?
Well, he's obviously a very wise man, been on the planet, some 30 plus years longer than I have, which and has just devoted a whole lifetime to researching. The stuff I've read about him is, I think he arrives at the office where they run Berkshire Hathaway from, and he shuts his office door, and then he reads all morning, and then goes out to lunch, and then takes some reading material with him, and then he comes back in the afternoon and shuts his office door and just reads some more, and he spends the whole day, and he goes home and reads some more, right? So he's just been that length of time on the planet and just continuously researching and hasn't given up doing it. I think he's almost making the statement is that, I don't know enough, and I've got an open mind to keep on learning about how this beast of financial markets work. But at the same time, I can't just spend my whole life researching and not executing, because the game's now, it's happening. I've got to take risk and invest while it's happening. And sure, I might have to adjust and learn as I go, but to have that open mind to keep doing it, I think is just unbelievable. I think the other thing is that, as him and Charlie Munger, as their wealth has grown and the amount of money, just the weight of money that they have to invest has obviously become a huge challenge for them, and it's the massive billions, tens, hundreds of billions of dollars of cash that they sit on and have to make decisions and find the liquidity to be able to do that to get a return is just a huge challenge. There's no doubt about it. And I think that's why, if you measure his decision making in the financial markets over the last 10 and even 20 years, he hasn't really been able to outperform the index. Over the last 10 years, he's underperformed the S&P 500, and over the last 20 years, he's underperformed the mid-cap index, the total return index. So, but whereas obviously all his earlier returns were just astronomical, and that's obviously a smaller amount of capital, more agile, was able to make decisions that paid off handsomely.
So his decision-making process, his system of making decisions, how would you describe that?
Well, he's got a process of continuous research, right? So he's obviously got the time to do it. I know people try and emulate him and Benjamin Graham before that and do all the fundamental analysis, but he's spending more than a full-time job on doing research to make his next decision, and that is whether it's to get in or out and to take profits. Whereas we obviously we've all got other lives that we live, and to be able to replicate the amount of time and effort, the tens of thousands of hours he's put into research to gain his knowledge, but also even the research he does to make each and every decision is just unreplicable by the average person. So teams of people still can't achieve what he's achieved just because of his research he's put in here.
Yeah. The executor of his will just grab all these funds and stick it into a low-cost index. What's the one drawback of doing that, though?
But I forgot about that, because I did write about that in the book. 90% of his wealth to go into the S&P 500 total return index, and then 10% left for liquid cash. The biggest drawdown is a thing called sequence of returns risk. I would say is that
what is that? Okay,
so sequence of returns risk is effectively the ability to be able to make back losses with reducing capital. So the time that it typically refers to is close to retirement or during retirement, when you are effectively a big fall in the market would decimate your account, your investment account. So if you're going along and you in the S&P 500 has been somewhere you've invested for 40 years, or the ASX 200 accumulation index has been somewhere you've invested for 40 years, and you've outperformed all the managed funds that come and go in that period of time, you get to 2 years before you're about to retire, and the index has a 50% fall. And now it's going to recover at some stage, but it's going to take maybe years to recover. and you've now got to start relying on that capital to start drawing it down and living off it, but it's halved in value. And so there is always going to be that 50% fall. They're going to happen in financial markets. Sure, they don't happen frequently, but they do. 10, 20, 30% falls happen obviously a lot more often. But if that 50% plus fall happens just before retirement or during retirement, that it's far more devastating to you as an investor and how it affects your day-to-day life, personal life, than if it happens when you're 20 or 30 years old, because the time for recovery will happen. So that is the number one thing that older investors have got to protect against, is if you are passive and are putting all your money into the S&P 500. Now, how much you have does obviously have invested when that 50% fall happens is of huge importance, because if the absolute amount that you need even after a 50% fall is sufficient, because remember, the dividends are based on the quantity that you own, not on the value of the account. Provided you don't sell, you could probably get through it. But don't, and if you're sitting in just one or two indices, it could probably still work, but you can't react. If you go and sell in fear or panic, then you've effectively, when you buy back in, you've halved your account value, and of course the dividends that you get, the income that you get out of it, is affected by doing the selling. But people sit there and they go, oh, I know that, Gary's just told me that, I've read it in a book, I understand that. Dividends are based on the quantity I own, not on the value of my account. I won't sell if that happens. I'll be able to sit through that. And of course, we know from research that some 85% to 90% people don't. They panic. They get affected by the noise that's going on around them, all the headlines, the tens of billions wiped off market values, and that appears on the front page of newspapers, all that sort of stuff. And they self-sabotage themselves. They don't have the psychology and the wherewithal to overcome that, and then they sell and they make a huge mistake. So what we so really what you're going to do is set yourself up in a regime whereby you avoid sequence of returns risk, either through the way that you invest or where your investments are, but certainly psychologically as well.
So you talk about the way that you invest. What do you mean by that?
Well, the way, if you can set yourself up with a way where not all of your funds are going to be subject to sequence of returns risk, and you can diversify across different strategies rather than have everything in one strategy. So the Warren Buffett 90% in the S&P 500, and I think hopefully there's a priority somewhere down in his will and his testament that says, don't sell if you're going to do 90% in the S&P 500 total return index. Then that could work for you. But if you are unsure of how you might react in an environment like that, or the world changes to some effect that we just can't perceive right now, then you want to be a bit more agile and active and be able to move out of that asset class into another asset class such as cash, and be able to control that risk, that downside risk, and to set up an investment plan, a regime, a way of investing such that maybe all or some of that is open to going 100% in cash in a timely manner.
Right. So when you talk about an investment plan, what are you talking about there?
An investment plan is I would call it a subset of a financial plan. So a financial plan we might have with a financial planner, or somebody would cover life insurance and a bunch of other things that are outside just investing. And it would include other assets like where you live and how you live and what your budgets are, et cetera, et cetera. But an investment plan would be specifically to do with your growth and income investment strategies, the precise detail of why you're doing it, what are you trying to achieve, and how you'd go about it.
Okay. So you just talked about the how. What are some of the things that could make up the how?
Well, I'm of a firm belief that the number one how that you'd need to have to protect against sequence of returns risk is how to know when to go into cash. When has it got to an environment, a situation where the probabilities are now becoming higher and higher that the market's going to fall further and further, and to be able to go into cash, because we don't know what's going to happen. Of course, markets could turn around as quickly as they fall and start rising again and keep going up, like we saw in March, April, May of 2020 with the COVID crash, or even the bottom of 2008 or 2002. Markets turn very quickly when fears at the highest. You want to miss probably the last 30% of it if the market falls 50%, and then get in relatively soon after that to get gains. So it's that how of having a high probability way, and you're not going to get it perfect, but a high probability way of avoiding the really big exhausting falling of the market and being in cash for at least a big chunk of your money. That's the one how.
So how do you do that? How do you determine when to be in or when to be out?
Well,
just roll the dice? Or?
Yeah, well, most people go on gut feel. I mean, I have friends and colleagues, no, not colleagues here, ex-colleagues who talk to me about this all the time, and they're trying to be passive. But when we have markets like we have at the moment, or that we've had certainly in the life of this business over the last 27 years, is that people can't be. When the noise and the news out there is about financial markets and it's all negative, it's extremely difficult to be 100% passive. It just defies how we're wired and human psychology, just to totally put your head in the sand and believe it's all going to come back. Now, if you invested in individual stocks, some of those stocks may never come back. If you invested in the index, well, then then it's easier to believe in that in an index ETF. So the how really needs to look at, and I'm a firm believer now, and having done this for over 30 years, is that price action, that is the movement of prices in the market, accounts, has everything, all the information known and unknown built into those price movements, as well as human psychology. It has all the human psychology and sentiment, as fallible as we are as a species, built into that price movement. And that is the only really true reflection of what's going on right now, regardless of what we may think should happen or may happen.
So in terms of that price action, how are you using that to decide whether to be in or out?
Well, if
how would you describe the process?
Yeah, so the whole thing about price action is that 1 day or 2 days or even 3 days or 5 or 6 days hardly matter that much, unless you're intraday trading, or really doing ultra short-term trading. But even so, even if you are doing intraday trading and ultra short-term trading, the big picture, counts for a lot more. And regardless of all the theory and the hypotheses written in universities about efficient frontiers and all that sort of thing, and rational markets and irrational markets, is at the end of the day, trends form. There's no doubt. You just can't defy that fact. We've got hundreds of years of data now that show that trends form, and those trends form that either rationally, and we can point to them and go, yeah, there's logical reason why those trends are forming, but they also form irrationally as well. And no matter how much logic you apply, you just can't fathom out a logical way to explain why those trends are going in either direction, either up or down. So when those trends form, you don't want to be fighting those trends. You don't want to be swimming against that tide. It's like jumping into the ocean in a rip and thinking that you're above the rip. You'll have the strength and you'll have the longevity of strength to be able to swim against it and survive, right? And so when those trends form, you just got to, that's the truth. Whether you believe the trend should be forming or not in either direction, you've got to go with that trend and not ignore it. And you want to have a way, an efficient way that doesn't take you hours and hours a day or a week to be able to recognize those trends and not to be able to swim against the tide. But sometimes the tide is just gentle, and sometimes it's gushing, right? Yeah. And it's a very difficult thing to do, but we have to go along with the probabilities and react according to those probabilities.
And so you've really spent a lifetime developing a methodology that is overlaid onto that price action, those tides in the market, to help you make decisions about when to be swimming with the tide or when to be, on the sand, out of the water altogether. What would be the difference between the way you're doing it and the way that Warren does it?
Well, the way Warren Buffett does it, I think, is he picks, well, I think he picks companies that are, cash flow just kings. That's really what his number one part is that he does. He picks companies that are the two big things I think are massive cash flow and low capital intensive businesses. So you don't need, he stays away from companies like BHP, where there's just the capital intensity of a project being built and then coming to fruition and then becoming, generating cash is years, sometimes decades.
Yeah.
So he stays away from companies like that. So he's looking for low capital intensive, high cash companies. And when he does that, obviously his universe shrinks quite dramatically, and to be able to put the sufficient volume that he needs to put in and accumulate a position in it. So the way that we do it is that because we're more agile and we've got lesser amounts of capital that we manage, is that we are looking for a point where we go, right, we're going 100% into cash. So we're looking for price action to objectively make that decision on our behalf and to manage a portfolio in a way that that kind of doesn't wear the whole 50% drawdown, but also takes advantage of run-ups to the degree that we can outperform the index by about a minimum of 2, but up to 5 or 6 or 7% compounded per annum. And we're certainly achieving that in the Australian market, and we were achieving it in the US market. But at the moment, that's for the last year that the strategy in the US market's been tested quite thoroughly. So what do we do about it? We go and do more research, and that's what we're doing at the moment. And timely to say it now. I know people will be watching this in weeks and months' time, but we will solve that problem, because the market's thrown a slush ball at us that we didn't encounter in any of our research. So now we're in that, we're living it, we're researching it and finding a way that, such as the next time that happens, we can guard against it, but in a way that doesn't take away the growth as well.
Yeah. Okay. So Warren uses fundamental information. He's got a wealth of that. He reads books all day long, etc. Your book, 15 minutes a week. The new book, 15% a year in 15 minutes a week. Why does it only take 15 minutes a week?
Okay. Why does it take 15 minutes a week? It takes 50 minutes a week to execute the process.
Right.
Why? Because all the research and preparation and everything is done up front. And so we've rehearsed scenarios, countless scenarios. Obviously, we can't rehearse every scenario because the future is unique. Yeah. But and the past is unique too. But the more scenarios we research, the better we prepare ourselves for what may come in the future. Can you ever prepare yourself 100% what's going to happen in the future? No, in no walk of life, and certainly not the financial markets, where there's probably more uncertainty than just about any other walk in life. But so it comes down to being a probabilities game. It's purely about probabilities, and setting ourselves up to have probably not only of making money, but of making money to the degree that it's better than the alternative, investing in an index ETF or investing the dividends, and in a way that's highly efficient, that we can continue with the rest of our lives and try and be as near passive as possible and achieve those outcomes. And the way we do that is we call it mechanical investing. So you need to have a pre-researched way, that this mechanical execution, this objective way, this of executing a process, an unambiguous process that doesn't make you sit and deliberate over whether you should or shouldn't. That's what makes it efficient. And it's not easy to do for a lot of people, because in the same way as people battle to follow an objective diet, or even to run a marathon and do the preparation to do the preparation, do the training, do the measurement of where you are, not get injured, and then also execute on the day. It's the same sort of thing. Do the preparation, then there's a higher probability that you'll achieve what you want to achieve on the day of execution, or the ongoing execution in the sense of the financial markets, compared to running one marathon. Yeah.